So for some thoughts on where international markets are heading, we have on the line with us Peter Esho, co-founder of Wealthy. Peter, good morning. Thanks very much for joining us. Now let's start off with just an overview of the results. We saw two big tech names that reported overnight, Amazon and Apple. Both fell short of expectations. Do you think that their results are a sign that inflation is starting to impact the American consumer?
Good morning. I think that they are signs, and it's not just Amazon and Apple, but also Meta the prior day, falling about 25%. We know Meta as Facebook. So what's going on here? These are basically businesses that are giving us live earnings to some extent. A lot of the inflation data, a lot of the GDP data, a lot of the unemployment data that we get has a lag in it, has a time lag in it, but corporate earnings give you a bit more of a feel, particularly in the United States where they report quarterly. And for me, Meta is perhaps more important because Meta is, again, we all know it as Facebook. It's an advertising business, and they derive their revenue from smaller businesses that advertise. And so when the economic cycle turns and the business cycle turns, the first thing that businesses do is they cut their spending, and the quickest spending you can cut in marketing is digital spending. Because you can literally click a button and stop your ads from rolling. And so for me, Meta is a real sign of the slowdown that's starting. If you have a look at the Bank of Canada yesterday in their statement, they are acknowledging things are slowing down. European Central Bank also overnight saying things are slowing down. And Australia, I believe, was the first major developed market central bank to come out and pull back interest rate rises. Instead of raising by 50 basis points, the Reserve Bank of Australia raised earlier this month by 25 basis points. And I think they led the world in this signal that perhaps a pivot is about to come.
Do you think the Federal Reserve notices all this, Peter? Because do you think that at the upcoming FOMC meeting, they'll actually hold back and be a slightly less hawkish when it comes to raising rates then?
I think the Federal Reserve has two things on the table. It has inflation, which it needs to control, and then it also has credibility. As a central bank, it got the previous forecast. It misread when they cut too hard and for too long. And so now they need to fix the mess that they created, which is inflation, but they have to also restore their credibility as the world's leading central bank. And for them to come out all of a sudden and change course doesn't go towards helping that credibility restoration. So I don't think that the Fed is about to change anytime soon, particularly given the most recent GDP numbers, but they will have to sometime early in 2023. And I think that'll probably happen around March, April. I think the door will start to be open. And by that, I mean some of the commentary, some of the Fed members might in public start to change their tone, but I don't think you'll see a Fed pivot until the first quarter of 2023.
So then should we start positioning for that pivot? Because, markets need to move ahead, right, of actual announcements coming out from the Fed. Is it too early to relook at equities, especially US? I mean, when you look at NASDAQ down 31% on the year-to-date basis, 20% for S&P 500, doesn't it start to kind of make you think, is it time to bottom fish?
The short answer is yes, absolutely. It depends on who you are and what your portfolio looks like, but it's a very good time to be adding to a well-diversified portfolio. It's going to be very difficult to pick individual stocks because if you take Meta, for example, Meta was looking very cheap, a few days ago, and then one day later it's 25% cheaper. Amazon was looking cheap. And tomorrow it'll probably open up 15 or 20% cheaper. So the indices overall as an aggregate are probably the way to play it. And the Dow is a perfect example because while the stock market's been coming down, we're starting to see the Dow outperform. So I think a very well diversified basket is prudent to be adding to in this type of market. And I think you need to have a long-term horizon. If you're day trading, if you're looking for that short trade, I think it's still very choppy. There's a lot of volatility, and I don't know if all the bad corporate news is priced in yet.
Peter, you've mentioned in commentary that you expect Australia is set for a surprise recession. What makes you come to that conclusion, and what macro indicators are you tracking to see if this happens or not?
The macro indicators that we're tracking is housing. Housing is the business cycle. And if you have a look at the housing market, we don't necessarily think that the housing market is going to go into free fall. So by that, what we mean is real estate prices are actually holding up pretty good. And the reason for that is that we're going into a freeze. We're calling it a housing freeze. And what the housing freeze means is that sellers are going to find it very difficult to sell, because when you sell, you usually have to rent something or buy something. Rents have gone up considerably in Australia, and the ability to buy on the same financing terms as what you had a year or two ago are not there. So it's harder to buy. So what's going to happen is a lot of sellers that are removing their properties from the market. That's reducing supply. That's keeping prices up, as well as the replacement cost of a house is going up because building costs are going up. But what happens is the real estate industry goes into a freeze. And construction in Australia represents about 10% of the labour force. If you take construction and retail is impacted by housing. When people buy houses, they usually buy more stuff, or they move between houses. And so about 20 to 30% of the Australian labour force is exposed to the housing market. Mm. And so as housing goes into a freeze and that activity dries up, our unemployment rate will go up. I don't know if we'll technically hit a recession, because Australia is a very well diversified economy. The mining industry is still going gangbusters, and that's filling up our federal government coffers. But I think ex-mining, there's going to be a bit of a slowdown.
Okay, Peter, but Australia is supposedly the lucky country, and the index, the S&P 200 index, hasn't done too badly. It's only down 8%. So with a surprise recession a possibility, do you think the index looks set to fall further?
The Aussie index has come off a little bit, but the Aussie dollar's fallen a lot against the US dollar. And so if you have a look at it in US dollar terms, there is kind of parity with other US dollar dominated index. And, when we say a slowdown, we're not talking about the end of the world. We're talking about just some moderation, a bit of steam coming out. And I think that's healthy. That's really, really good, because if you've had record strong growth and, our unemployment rate is at 3.5%, the economy is finding it very difficult to function. It's difficult to hire people. So a bit of a moderation and a bit of a slowdown in the business cycle is good. That's what we're saying. We're not saying that, we're going to have a massive economic collapse that's going to be at a detriment. So corporate earnings are holding up relatively okay. But, yeah, there's a bit of a freeze coming in housing. And I think what will happen also is, as the US dollar starts to weaken next year, the Aussie dollar will bump up a little bit, and you will start to see, those returns reflected in the stock market.
Peter, thanks very much for speaking with us this morning. That was Peter Esho, co-founder of Wealthy, giving us his take on some of the trends that he sees moving markets.